Hi, hello friends. Welcome to the officer series of ABM. In officer series, we are covering all the subjects ABM, BFM, ABFM, BRBL, all the numericals, objective questions, case studies, important theories, everything we are covering. So watch the series completely, share it with your friends, like the video, subscribe to the channel. Do this first. Everything is freely available. Subscribe, click, and immediately you can get the updates also. Today's topic is analysis of financial statements. This is unit number 18 in module C. We'll be dealing with it and very important topic. I've taken directly the excerpts or the points from the book only. So you'll be directly getting the information from the Macmillan book. Various ratios we'll be covering. Okay, I'll be covering various ratios and the importance of those ratios will be discussed. Let's start. Liquidity ratios. See, firstly remember in ratio analysis, there are three types of ratios. Okay, there are three types of ratios. Number one, liquidity. Number two, profitability. And number three, solvency ratios. These are the three ratios. Solvency. These are the three types of ratios. Okay? Liquidity, profitability, and solvency. So we'll be studying one by one. Liquidity. Firstly, what is liquidity ratio? Why do we have liquidity ratio? What do you mean by this? See, liquidity means basically, do you have the money to cover your short-term expenses also as well as long-term expenses also? There are two types of liquidity. Means mainly short-term. See, liquidity will mainly focus on short-term. Long-term liquidity is also there. But we mainly focus on short-term in liquidity part. So, which are the important two ratios? One is current ratio. It is an indicator of liquidity that is available, that is the ability to meet the commitments in time. It is expressed as a simple ratio by dividing the current assets to the current liabilities. So, current ratio is an important ratio over here in terms of liquidity. Now, one more point we can mention over here, that a parallel to current ratio is also known as anyone? Liquid ratio. Liquid. Okay. So first let's study current ratio, then we'll be covering liquid ratio also. So current asset upon current liability. Simple. Current asset divided by current liability. That is equal to your current ratio. And is benchmarked normally to 1.33:1. So 1.33 is the best ratio, where 0.33 over 1 is the surplus of long-term sources over the long-term uses. Means your assets are 0.33 higher than the liabilities. Simple. Okay. So my current asset upon current liability should be at least equal to 1.33. Okay. Now coming about the liquidity part, liquidity ratio, that is not given over here. Liquidity ratio equals to liquid assets, liquid, see earlier we had current assets, now liquid assets divided by current liabilities. See, liabilities are current only, current liabilities. So liquid assets divided by current liabilities. So this is known as liquid ratio. This is a very good indicator of short-term solvency, short-term liquidity also. Okay, you will be studying them in solvency also, because this current ratio is basically, this gives you the overall picture of short-term liquidity. Okay. Next, NWC, net working capital, gives the long-term support available to build up on the current assets, indicating margin available over the current liabilities to finance current assets. Expressed in percent, formula is NWC upon total current assets into 100. Now, what do you mean by this? It's very simple. It means that NWC equals to NWC. Okay. Now, this formula is known as NWC upon TCA into 100. But net NWC, if you want, it is basically current assets minus current liabilities. Current asset minus current liabilities, that is equal to net working capital. Okay. So NWC ratio gives the long-term support. Long-term support. How much more current assets you have as compared to the current liabilities. The formula for this is, actually see this, NWC formula is this, NWC whatever is the difference, current asset minus current liabilities upon total current assets into 100. Okay. So this difference upon total current assets into 100. So this will give you the idea what is the excess of current assets you have over the total current assets, means excess of current assets upon total current assets into 100. So this is about liquidity. Next we have profitability ratios. Now in profitability ratios, there are various ratios, roughly 7 or 8 are there. 7 or 8 ratios are there. Okay, so we'll study one by one. Raw material consumption ratio. What do you mean by raw material consumption ratio? Raw material consumption to cost of production ratio gives the sensitivity of raw material price. See, sensitivity of raw material price. The most price sensitive input of production on the cost of production. So it will give you, what do you mean by this word sensitivity? Sensitivity word over here means the change of the element based on the benchmark. If my raw material changes by, let's say, 1 rupee, then by how much is the cost of production changing? Okay, so it means that it's basically sensitivity means related to 1 unit change in the benchmark. So sensitivity of raw material is given by raw material consumption to cost of production, raw material consumption upon cost of production into 100. So this is known as sensitivity of raw material price. Okay. This formula you have to remember, value of raw material consumed upon cost of production into 100. Okay. Second one, PBT ratio means profit before tax. PBT ratio gives the share of profit before tax in sales revenue. Share of profit before tax in sales revenue and is arrived at by the formula profit before tax into net sales. Upon net sales into 100. Okay. So profit before tax upon net sales into 100. Now this profit before tax, you can call it as a net profit ratio also. So that's why it depends. Net profits are of various types. Net profit before tax, after tax, many are there. Mainly these two. So profit before tax upon net sales into 100. That will give you the PBT ratio. Next is PAT ratio, profit after tax ratio. It gives the share of the owner's earnings in sales revenue by the formula. Profit before, it is profit after tax, it should be after. Profit after tax upon net sales into 100. Okay, because you are calculating profit after tax over here. So share of the owner's earning, see, how does this PBT and PAT work out? How does this PBT and PAT work out? See, it's like this. First, always it is EBITDA, earning before interest, taxation, depreciation and amortization. This is known as EBITDA, or you can call it as a gross profit also. From here you subtract this depreciation and plus amortization. Amortization means D and A. These two are first removed. So you get EBIT. So this EBIT is also called as operating profit. Many a times it's called as operating profit. Operating. Okay, it's also called as operating profit. When you subtract interest minus I means interest plus taxation, this T. So what you get is this PAT. So net what you get is this PAT, net profit after tax. Okay, this is how the overall system works. EBITDA, then from that depreciation and amortization subtracted. From that, then you get operating profit. From here you subtract interest and the tax paid, and then you get NPAT, net profit after tax. Okay? Got it, everyone? These are the three profitability ratios. More are there. First, everyone is clear about this? Because this ratio analysis is very important. Okay? Next, EBITDA. Just now I told you EBITDA, earning before interest, depreciation, EBIT, interest, taxation, depreciation and amortization. You call it anything, EBITDA. Okay? So EBITDA margin is an important financial performance indicator and measure of units operating performance. So basically it's an important, so that's okay. Measure of units operating performance. The ratio is arrived by the formula. So what is the EBITDA formula? So EBITDA margin ratio, if it is asked in the exam, EBITDA margin ratio, then it is EBITDA, that is profit after tax. Now what is EBITDA? See this. Profit after tax plus interest plus depreciation plus tax plus amortization. Just now we saw all this. So EBITDA means all of them included, divided by net sales. Everywhere you will find net sales only, divided by net sales into 100. So this is known as EBITDA margin ratio. If in exam they ask you, find the EBITDA margin ratio, then you have to find out, right, EBITDA divided by net sales. Okay, EBITDA divided by net sales into 100. Okay, in exam they might give you EBITDA only and net sales and directly they'll ask you, or they might give you profit after tax and these separately, and then they'll ask you EBITDA. So you have to add all of them, divided by net sales into 100. Next one is return on capital employed, ROCE, return on capital employed. Okay, or you can call it return on investment also, means whatever I have invested. Capital means what? Whatever I have invested. So return on capital employed is also called as ROI. So used to measure operating performance in relation to the total capital employed in the business and is calculated by the formula. So what is the total ROCE formula? Return on capital or return on my investment. EBITDA divided by total asset side, total of asset side of the balance sheet. So ROCE equals to EBITDA divided by total of the asset side of the balance sheet into 100. Okay? Kindly remember, EBITDA divided by total of the asset side of the balance sheet into 100. Very important ratio. Okay? So return on capital employed is equal to EBITDA divided by total of the asset side. So asset side means what? This asset side will include both the assets then, current asset as well as long-term assets. Okay? It will include your stock, debtor, prepaid expenses. Okay? These all come under current assets and net profit. Okay? So these are all, and net profit is on the other side. Current asset, it will include your stock, debtors, this prepaid expenses, okay, and one more is there, cash. So these four are included under current assets. Long-term assets are of two types. It can be a long-term tangible asset and long-term intangible asset. Tangible means all your factory, shed, car, anything. Okay. And intangible means your copyright, your trademark, patents. These are all the intangibles. So it will include all of them, total of asset side of the balance sheet. Different formula are given by different academicians for calculating ROCE. However, the most accepted one is above, where EBITDA, the operating result plus other income is tested against the total amount employed in different assets to generate that EBITDA. Okay. So basically this is the most accepted formula, EBITDA upon total of asset side of the balance sheet. Then operating profit ratio. Operating profit ratio is calculated by operating profit divided by net sales. Now operating profit I gave you earlier also, that EBITDA minus depreciation, amortization, EBIT. That also you can call it operating profit, or you can get it in different way also. So operating profit ratio is calculated by operating profit upon net sales into 100. Your non-operative income and non-operative expenses are weeded out, means they are removed, to arrive at the true profitability of the business without them, which need not be repeated every year. So what is non-operating expenses and what is non-operating income? These are also called as capital income and capital expenses. Now what is capital income? Non-operating means regular business, means operating. Regular business which I am doing on a daily basis. Okay, so that is known as operating. So suppose if I sell my furniture on a daily, means I am a normal shopkeeper, I will sell my furniture in the shop. So that's not my daily business, isn't it? I am a simple retailer and I am selling my furniture. Or I am having one car which I am driving, now I will sell it. So do I sell the car every year? No. So that is non-operating profit or income. Again, similarly, non-operating expense also. I purchase the machinery for production. So do I purchase the machinery every year? No. So that becomes a non-operative expense. Okay? Got this point, everyone? What do you mean by operating profit ratio? Got it, everyone? Operating profit ratio is operating profit divided by net sales. One more is there in profitability. See this, the IRR, internal rate of return. IRR is a metric used in the financial analysis to estimate the profitability of the potential investments. Potential, profitability of the potential means future. Here we are talking of future investments or future returns. It is a discount rate that makes the net present value of all the future cash flows from the investment equal to 0. So IRR is a rate of return at which NPV equals to 0. Kindly note, IRR is the rate of return, internal rate of return. It is a figure or rate of return when NPV equals to 0, net present value equals to 0. Okay? So NPV equals to 0 is discounted at a cash flow in a discounted cash flow analysis. The formula and calculation used to determine this figure is always shown this way. 0 equals to C1 upon 1 plus R plus C2 upon 1 plus R raised to 2 plus C3 upon 1 plus R raised to 3 plus blah 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 minus raised to n minus my initial. Now this part, if your C1, C2, C3 are same, then you can use the present value formula. Okay, C into 1 plus R raised to n minus 1 upon R into 1 plus R raised to n. Okay, so future present value formula, that also you can use it. But if the cash flows are different, then you have to use it this way only. Cash flow 1 divided by the year, this 1 plus R raised to year. Cash flow 2 divided by this and minus my I, initial investment. Okay, so this is known as a profitability ratio. Now comes leverage ratio or solvency. Okay, leverage or solvency. Now look at this. What do you mean by leverage? The ratio of owner's funds to borrowed funds is calculated in different schools in different way. Means owner's funds, my own funds to borrowed funds. We also call it as a debt equity ratio. Outside debt upon equity, my own funds. So somebody calls it debt equity ratio, sometimes somebody calls it owner's funds to borrowed funds. Most accepted one is total outside liability upon total tangible net worth. Okay. Now what is total outside liability? Total outside liability is the sum of term liabilities and current liabilities. See, these are also taken. In debt equity ratio, we generally don't take the current liabilities. But in this ratio, we are taking both of them. So, long-term term liabilities from outside divided by current liabilities. When I take a bank loan, when I take a bond, issue a bond, so that will also come under the term liabilities, long-term. And current liabilities means your creditors, payables, EMIs, CC, OD, that is all under current liability. Total net worth is net worth minus intangible assets. See, minus intangible asset. Your copyright, your patent, these are all subtracted. Okay, so these are called as intangible assets. Those are subtracted. So net worth minus intangible assets. It is expressed as a number of times. It is expressed as a number of times. Okay. More conservative approach is to eliminate from the total net worth the loans and advances and investments to or in a group associate subsidiary companies, as those monies have gone out of the system while some of the risk elements across the entities are common, right? So here kindly remember, this is not that important for you, but just for your information, conservative approach means if you have to play on the safer side, you have to eliminate from this total net worth loans, advances and investments to or in the group associates. So basically remember, whenever you give a loan to the group subsidiary company, that is to be subtracted. Okay. Total outside liability upon adjusted tangible net worth. See, now tangible net worth has become adjusted total tangible net worth, where adjusted tangible net worth is T and W minus loans, advances and investments in group or associate subsidiaries. Okay. Next is debt equity ratio. Debt equity ratio means long-term debt upon equity. Debt equity has two connotations. One is that the ratio between the debt and the margin for the project. Debt means outside loan and the margin. Okay. Margin means my own money. It is arrived at debt component of the means of the finance upon margin component of the means of the project. Okay. Margin means the margin which I am bringing into the loan. So debt component means the bank debt divided by my own margin. How much loan I am taking from the bank upon how much I am putting my margin. Generally what we say is 75-25. 25% is my margin and 75% is a bank loan. So it will be 75/25 if I am using 75-25 ratio. Okay. So debt component in the means of finance upon margin component of the means of the project, and is expressed as plain vanilla ratio of numerator upon denominator. Okay. Long-term debt or net worth is the ratio used as indicator of solvency of an existing company. Solvency means long-term solvency, whether this company will stay in long run or whether it will collapse. Debt equity ratio is also used to assess the solvency of a company as a whole, especially by financial analysts and media analysts. For them, the formula is total outside liability upon net worth. Total outside liability means the same thing which we saw earlier. Current asset, current liability and fixed liability, long-term liability upon net worth, and is again expressed as a plain vanilla ratio. Okay. So this were the main this solvency ratios. See, various names are there: leverage, solvency and gearing ratios. This anything can be asked to you. Gearing ratio, solvency ratio or leverage ratio, and one more is there. that is coverage ratio. Coverage ratio means basically DSCR. There are two parts, DSCR and ITR. Okay. So DSCR, debt service coverage ratio. It is a measurement of unit's ability to service payment obligation of the debts out of its future earnings. Whether the company will be able to pay my EMI. Main is my EMI. Okay. There are two variants. One is net DSCR and second is gross DSCR. What is the difference? Logic remains the same. Okay. Gross DSCR, of which the former assesses the ability to service installments, while means net DSCR gives you the ability to service the installments, while the latter assesses ability to service installment plus interest. So net will give you only installment, gross will give you installment plus interest, both of them. The formula is to calculate net DSCR is cash accrual, that means net profit plus non-cash expenses, upon ETL. ETL means equated term loan, EMIs for term loan, basically EMIs. ETL, equated term loan installments of all the term loans during the corresponding period. So all the EMIs which I am paying, that will be division over here. So cash accrual upon all the installments. And the formula for gross DSCR is cash accrual. See, here it was only cash accrual. Here cash accrual plus interest on all term loans. Okay, so net is only cash accrual and gross means cash accrual plus interest on all term loans. Okay, upon ETL on all the term loans during the corresponding period, plus again this comes over here, interest on all term loans. So gross DSCR will include this, interest on all term loans, that will be included in gross DSCR, not in net. Okay. As we need to assess the capacity to service the interest as well, it needs to be in the denominator. Also, net profit on the numerator is arrived after reckoning interest, which we are testing for repayment ability. Means what are we doing actually? Net profit on the numerator is arrived after reckoning interest, okay, which we are testing for repayment ability. Reckoning means getting that interest. See this over here, net profit plus non-cash expenses, and here in gross interest on long-term loans you are adding back. Why are you adding back? Which we are testing for repayment ability, whether I will be able to repay that interest. Therefore, it needs to be added back on the numerator also, and to neutralize the effect, that is interest on all term loans upon interest on all term loans, means neutralizing that effect. Okay? Got it? See, you need not remember all the remaining part. You only remember the formula. Net DSCR formula, cash accrual upon EMI. Gross DSCR formula, cash accrual plus interest on long-term loans upon EMI plus interest on long-term loans. These two formula you remember. Okay? So now, everyone, before going, the new batches of Adda 24/7 have just started. They are in the starting phase. Join them ASAP. Okay? Just recently introduction has been done. That's it. So CAIIB Pro batch for CAIIB and join it ASAP. And if you are for JAIIB, then JAIIB officers batch. Okay? Anyone. For JAIIB officers batch, and for CAIIB Pro batch. Okay? Join this ASAP. Or it's a detailed batch. All the numericals, objective questions, case studies covered. Join it ASAP. E-books, mock tests, live classes, recorded sessions, everything you have. So join it ASAP. And it's still in the starting phase. Just introduction has been done. So for purchasing, you use the code Y432. Remember, the code Y432 will give you the highest discount. Click on apply. Look at this, 82% discount plus 1% extra, 83% by downloading the app. So 83% discount you are getting. I would also suggest you to join the increment Mahapack, see, of under 24/7. It's one of the best Mahapacks for you, CAIIB increment Mahapack. Right now, triple validity offer is going on. If you join this Mahapack, you need not join any other batch. No other batch is needed. Everything is included in this. 15 plus batches per subject. Per subject 15 plus batches. Huh? So that is there. Plus 15 plus batches over here plus triple validity. Means you buy for 5 months, you get it for 15 months. You buy for 9 months, you get it for 27 months. Plus 83% discount is there. Don't forget that. Plus you will be getting physical question bank for all the subjects. Plus you will be getting physical formula bank for all the subjects. So it's win-win situation. Study planner, join it ASAP. 15 plus batches and triple validity. And in fact, electives are also covered. So what's needed more? Again, so join ASAP. Okay, CAIIB increment Mahapack. But never forget the code Y432. Y432 will give you 83% discount, triple validity, physical question banks, formula